The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So let's discuss stop losses then. Now that we know two separate ways to actually enter the markets, both market execution and using pending orders, we can then discuss our risk management with stop losses. So remember, stop losses are your protective line of defense. The price to exit at a loss if the market fails to meet your expectation. So it's not something, of course, when we place a stop loss, we're thinking, okay, the stop loss is there. We wanted to get hit at some stage. Absolutely, that's not the case. It's a level of protection, a line of protection. If the market fails to meet our expectation, we are effectively incorrect in the trade decision, and we're just getting out of the trade for small losers. Losing trades are absolutely inevitable. Profitable traders can cap losses. So again, that's what we want to do. We want to cap our losses before they become too great. If you're making 5 trades and 3 of them become €10 winners, you've effectively made €30 on the trades. Then the next 2 trades, if you define your risk at €5, well, for want of discussion in terms of describing portfolio risk management, they're effectively free trades because you've made profit overall during the day. Now, you do not want the next 2 trades to become €5 losers, but as an objectivity, you should, of course, feel very comfortable placing those trades, because if you're to take those losers, you're effectively going to be €20 to the good and showing profit. So that's all in terms of psychology and sort of giving yourself that mindset to outperform in the markets. So profitable traders can look to cap losses with stop losses, of course. We have a predetermined capital amount. Okay, so it's not only a question of pips, whether we look for a 100 pip gain or a 20 pip loser, something like that is a positive risk reward ratio. It is a capital amount. We need to know the monetary exposure that we have on our trade. And again, it can be moved in order to lock in profit. So if we buy a market, the market moves up, shows us a lot of profit, then we can move that stop loss order to a break-even point. So effectively, we have mitigated all risk in that particular trade. Again, if the market continues to move up, we can move the stop loss up again to maybe capture in at a technical level of profit, or perhaps a quantifiable amount, a monetary amount of capital that we'd like to lock in as profit to the trade. That's effectively the real advantage to mitigating risk across a level of many different trades as a portfolio trader, and of course just in terms of securing profit in the trade if markets pull back, which they can. So let's look at this as a practical example here. We look to buy the market in this particular example, okay? So what we'll do here effectively is buy the market in and around this price. So we've seen the market trade up. We look to buy the high of this market, this candlestick here, and we see a long market entry. Okay, so we've just bought the market around this level. First thing that we do, guys, is of course place our stop loss. So we've picked a level, whether it's a monetary level or a technical level, to place the stop loss as the market trades to the upside. Okay. What happens then is we see the market trade up, and we want to capture in some of that profit. How do we do this as the market trades up? Well, we'll move our stop loss to a specific level. So the benefit of this is not only to look to mitigate risk, it's to actually lock in profit. So I'll just discuss this in a little more detail. What I'll do is use a level, just a green pen here to describe this. So why would we have taken this trade? Well, we took this long market entry just here, and it's at this candlestick here, and the market consistently trades to the upside. So when we see the market trade at these prices here, we see the market roll over and then trade to the upside with this candle here. So as a technical level, what we might look to do is move the stop loss up to the last corrective low, which is here. So that's effectively looking to follow the momentum, but on a technical level where we might allow us to book in more profit, of course, if the market moves up to the upside, but mitigating risk along the way. And again, as the market continues to trade up, we could select another level, perhaps here, to look to book in profit if the market looks to trade up again, or perhaps roll over, which it does in this case. We'd be looking to book in profit in around this price. Of course, we could have done it again at these lows here, and that would be a fantastic trade. So again, many advantageous issues in terms of placing your stop losses, not only to mitigate risk or take risk off the table, but to book in profit or lock in those profit opportunities should the markets reverse. So that's the question there in terms of assessing the market. What should we do at this stage? What is likely to happen? Of course, we're in a long-term trend here to the upside as expressed. Again, totally hypothetical. There's no right or wrong answers. What we could do is lock in profit here at this stage. At this stage, we can move our stop loss up. And again, as the market pulls back to the downside, we are not exposing all of this capital, all of this potential capital that we made in this trade. We actually are looking to lock in profit as the market moves up with us. So let's have a look at shorting the market here. We're going to sell this market to the downside. So here we have an inflection point within the market. We know we have a possible short entry, and we've taken a short entry just here as the market looks to hit this little rollover period here. And I'll just describe this in a little detail. So the market can't breach these highs here and looks to roll over. So what we do, we've seen over the last few times it's done this, that there is possible momentum showing short-term movements to the downside. So is there profit available? Well, of course, that might be the case. So we make this trade here and we look to follow momentum to the downside. We get a short entry again here. What actually happens in this trade? Well, as soon as we enter the short market, we place our stop loss again above the corrective high, perhaps in this example here. And what happens really? Well, the market trades down, but instantly, as soon as the market trades down, it reverses. So the market looks to effectively reverse and get us out. What happens is, of course, our stop loss is triggered.